Welcome to Value Investing webinar. Today we are going to talk about the turbulence and role of value investing in turbulent times. With me here is Atul Kumar, the portfolio manager at Contra Asset Management, to discuss about value investing in turbulent times. So, the stock market by its very design is volatile, and there's nothing new about it. And it has, perceived to be much more volatile now. I came across this new jargon, VUCA, volatility, uncertainty, complex and ambiguous. But I guess it has always been like this on a relative basis. But with the pace of communication, the way, the interconnectedness, the globalized world that we live in, it has become, more profound. It looks like it is far more volatile than it used to be. Though when we try and measure it from a different yardstick, it is not so. But still, the perception of greater uncertainty dominates our mind, and we see that the interconnectedness. Something happens elsewhere, and we are immediately impacted. So we are going to talk about all this and much more with Atul. So, as a portfolio manager, when you have a lot of your investors who have entrusted their money, what are your biggest concerns in this market? In a week's time, so many things happened. We almost, the tension with Pakistan, we almost came to war, some greater uncertainty. Every day we were thinking that something else dominates our mind. And so how scary it is? What keeps you awake at night?
Okay. So first of all, thanks Dhirendra for having me once again, and it is my pleasure to be here. To start with, there is always a lot of noise which is there in the markets, in the press, and as investors, one has to sift through all the news and find things which are relevant, which are important. Coming to the concerns which are there, when we are looking at in the current scenario, so people would be having a number of issues in their minds, right from what is the current situation in terms of the border. There are concerns in terms of elections which will be there in the mind of various investors. People would be looking at also recent times, could there be a number of popular measures that could have an impact on the economy and various other things, whether it is inflation, deficit, all those kind of macro things. When we are looking at it, from a longer term perspective, there are two risks which we are looking at. So one is obviously for the near to medium term, that is in terms of the US monetary policy, how the US Fed is tightening or unwinding in terms of their interest rates, or how much they are, let us say, shrinking the size of the balance sheet, which they had
How will
happened.
it affect your decision? How will it affect your decision?
Yeah, not really.
About portfolio company?
Yeah. So from when we are looking at it, the valuations of the companies or the valuations of the overall markets, they are in a way lot dependent on what the US Fed does. So what we have seen,
global liquidity.
Yes, so global liquidity, etc. That becomes a kind of a concern, and what we have seen for past few years, that all the asset prices, they have been rising up, fueled by the liquidity which is there. Now, if the interest rates are tightening in markets such as US, and if other economies are also following that, then the amount of money which has come to India or to other emerging markets, that could probably reverse, because people there get a good return in terms of interest rates in their domestic economy, and they may probably not take risks by investing in emerging markets which may have volatility. They may have to take exchange rate risks, etc., political risks, many of them, those things. And probably we saw some of that towards last year, where a number of emerging markets currencies or their markets, they were taking a hit because there was a lot of tightness in the dollar liquidity. So that is one thing, and the other big uh, uh, issue that we worry about is in terms of unemployment from an Indian perspective. Everybody talks about there could be
So these are two macro things that you keep
yes,
an eye on.
correct. Yeah. So people talk about demographic dividends because we have a youth population. There are about 10 million people who are coming out of the education system and joining the workforce. Now, if we are not able to create right jobs for them, then there would be an unemployment kind of a problem. All these people, they are young, energetic, have high aspirations, and they are connected through mobile phones. So there could be social unrest. That is now the unrest is even in some of the Western markets. For example, in the US, there are a number of people who are retiring, and we talk about problems in terms of pensions, that the pensions, etc., may not be able to fully support. There could be some kind of, let us say, their pensions could be underfunded or that side. But as compared to us, their problem is dividend. All these people, they may be 65, 70-year-old. They would probably at some point of time be old, lie on beds and pass away. Whereas in India's case, this is a totally altogether different challenge because
context,
these would be the people in their 20s. Yeah.
So while this whole tension with Pakistan happened, how much it was part of your early morning meetings?
Yes, so I mean, obviously, as a citizen, one would be concerned in terms
No,
of.
but as a professional fund manager,
Correct, yeah.
responsible
So
for
as
management,
a
how much
professional,
was contributing to your thinking in terms of reviewing your portfolio, doing something about it?
we would not be so much concerned in terms of from a portfolio perspective. Because we are at the end of the day long-term bottom-up investors, stocks which are coming to our buy limits or they come to our portfolio, then obviously we would go ahead and buy them. And frankly, I mean, these things would not have so much relevance from a long-term perspective. I mean, we as a country, we have lived through a number of tensions, problems, all across. I mean, as we were discussing earlier, that there is something which happens on a weekly basis. So India as a country, we have lived through wars, we have lived through famines, we have lived through riots, and India still continues to grow at
What
about
Warren
6,
Buffett said was,
6.5%.
the India tailwind,
Correct.
because that carried on, and that has had an impact. Now let me ask you something which is very specific to your fund. You run a value fund, buying something at a discount or below their intrinsic value. Is there any specific advantage that you have in these uncertain times when such a noisy thing happens, which dominates our mind?
So the advantage which we would have is because being value investors and we would, if we are not finding good value in the markets, then we are into the cash. So there is no compulsion of us to always be invested. And I mean, there is always some kind of a cash in many of the times. So if there is any volatility, if there is any kind of a fall in the market, then we can, at many of the times, we can jump in and we can buy particular stocks. So also because we are because this is a value fund where the P ratios or many parameters will be lower as compared to many of the growth stocks where people are looking at a multiple growth in the earnings, etc. So from that perspective also, these stocks would be less impacted because
or they'll be relatively more stable.
Exactly, they would be relatively more stable.
So, this idea of value investing was propounded many decades back, and that was a time when the world was not as connected as it is now. Today we see that businesses are connected, something happens somewhere, and our dependence or interconnectedness of business markets has an impact. The exchange rates are quite meaningful. Every country has a huge partnership of trade. So in that sense, do you think that all the things that was propounded many decades back, the basic tenets of value investing, in view of this greater uncertainty, a new completely very complex dimension added to businesses. Your value investing needs a revisit, or it is still valid today?
I would look at it that probably the interconnectedness which has been there in the markets, probably many a times it can offer much higher opportunities to people who are prepared to take advantage.
So you are saying volatility is good.
Yeah, to a certain extent,
Okay.
because let us just discuss the most recent example, which was, let us say, 2008 crisis, which was there. Now, if you look at that particular period, the Indian markets, they had fallen from levels of 20,000 to maybe about 7,000 on the Sensex level. So there was a big fall because people, people were pulling out their money. There was a lot of uncertainty at the global level. But this uncertainty or pulling out was much more on the financial markets, right? And the financial markets, they are a derivative of the real economy. So, but when we are looking at the real economy, I mean, we have seen that India did not really slow down except for maybe a couple of quarters where the GDP numbers were bad, but very soon we bounced back. And you look at any particular number, or let us say the India's consumption, whether it's across various industries, that has only grown. So the financial economy, which is a derivative that many a times dominates the real economy, but I think that over a period of time things find sense, and the money which is going out, that at some point of time returns, because the underlying economy still is very strong. I mean, you look at across industries.
And of course, the economy did not shrink to 50% of its scale.
Correct.
The way the Sensex did, or more than 50%. Yeah.
Correct, yeah. And many of us, for us, for example, it was a great opportunity to deploy our cash, because before that the markets were
But
at
that is
levels,
what actually crosses my mind, that is also that the converse is also as true, that when markets go up by 40% in 2007, then also the economy hasn't bloated or has grown in size at that pace.
Correct.
So it's basically a course correction, isn't it?
Yes, but then as a value investor, probably one can sift through all the data, probably
And keep off.
Correct,
Keep
exactly.
away.
Yeah, probably.
So if you keep away, then you don't lose. You don't gain, and you also don't lose. So
Yes.
you are back to the square one. To a
In the
reasonable
sense
extent,
that,
yes.
in the sense that probably when there is a lot of risk on, then you are not playing into that.
Okay.
And in the sense that you are not bagging into many of the stocks, let us say, which could have gone up not just by the 40%, but there were stocks which were going up by 80%, 100% as well.
Okay.
So, I mean, from a relative
The frothy
perspective,
part of the market you kept
exactly,
away.
is
Okay.
you keep away from that, and you try to be much more sensible in terms of what you want to buy, and you keep cash on the sidelines because the valuations are on this thing, and when the opportunity comes, then
Waiting
one
for
can
the opportunity.
exactly get into that.
So thank you very much, Atul. Now I'm moving to the questions which a lot of investors have posted for you. Karangia, I hope I have spelled his name right. What is asking, what is the difference between Contra, value and special situations fund?
Correct. So I would say that the value part, we look at lower in terms of price which we are willing to pay.
Company
so for
which
a
in your
particular
impression is, or your understanding is of higher value and available cheap.
Correct, that's
Okay.
right. Yeah,
Okay.
the contra could be little different in the sense that they could be looking at maybe something is going down, and they would like to buy that. Probably that would be my understanding of that.
Yeah, something which is out of favor
Exactly.
and somebody's taking a bet on that.
Yeah,
Okay.
whereas a value, we as value guys would, obviously we would note that something is going down, but the next step would be to do much more research on that, that is the company could, is it a temporary problem? Is it much more a cyclical kind of a problem, or is it a
Permanent problem
kind of a problem? And then based on that, and special situations is, as the name says, that there could be some particular
Anything extraordinary happening to a company, a turnaround, a buyout or something which is causing an opportunity.
Sure.
Samit is asking that how can I assess a stock whether a stock is overvalued or undervalued? Now give him the formula.
Correct. Yeah. So obviously, I mean, it's never so
It's not that easy.
Correct, exactly. We can look
But
at.
still, if you can give 3-4 things one should start from.
Yeah, I mean, one thing is obviously in terms of relative valuations that you look at a particular sector and
Any one
how.
variable which you start with?
I mean, we would be looking at a number of things, which is in terms of
One thing.
valuations. Yeah, it
Tell
would
me
be
one
the
thing which will be the starting point.
Correct. Yeah, maybe the P of the stock or price to book number
Relative to other companies
yeah,
or
relative
to its own past history.
Correct. Yeah, that would be one
That would
thing.
be one
Dividend
thing.
yield. Yeah, obviously it's not
Okay.
one metric, but then a mix of metrics and looking at how it is doing versus what its peers are doing probably could be the one way of looking at it. How it is doing vis-a-vis the overall the benchmark or the broader market could be other, because there is also sometimes so a particular sector itself could be very, very overvalued, or let us say it is trading at a very to phrase it properly, trading at a relatively rich valuation as compared to many other stocks in the sector.
You have been practicing value investing, and Priyaranjan is asking what distinguishes the value trap from a value investment. So I'll just rephrase this question: that what are the characters of a value trap?
Yeah, so at the end of the day, there has to be, for any particular value stock, there has to be a particular trigger for the earning growth, or I mean, because if the company is not going to do well, I mean, probably it is going to remain at the same levels, or it may probably fall even further from the current levels, at which it is. So there has to be some kind of a element which can turn around
Just
the
give
earnings.
me an example. Example without revealing the name of a company.
Correct.
That it was a value trap.
Correct.
What you saw and it actually did not turn out to be true.
Correct.
Can you give me an example?
Yes, so for example, there was one capital goods company which we were looking at, and the valuations of the company were looking to be attractive. It used to be valued very, very highly in 2006, 7, 8, 9, when let us say the order book sizes used to be quite big. They were growing, and then in the street, obviously, there were a lot of people who were very much pushing that particular stock, that see, it has fallen to these levels. There is a great correction now. This stock, which used to be traded
Available cheap.
Correct, yeah, in maybe in P of 20s plus, now it's coming in a single digit kind of a P. When you look at the numbers, obviously you find that its major drivers of orders, they were probably slowing down. There was a capex
they were disappearing.
binge, correct, yeah, which happened in 2006, 7, 8. But then in the new kind of a scenario, there was a lot more capacity available in the industry. There were many Chinese guys who were coming and setting plants in India. And on top of that, the ordering activity which was there, probably in the new era, the ordering activity became 1/3 or 1/4 of where it was.
So things change. So
Correct.
it turned out to be a value trap. What looked like very valuable, the underlying dynamics changed.
Correct, yeah. So even though the valuations are
So you
looking
have to
cheap,
keep an eye on the environment of what is it. So the future was discounted in the stock price well ahead of time. It was rightly a value, justifiably remained a value.
correct, yeah. So until unless you find some kind of a catalyst to that company, to the earnings, to something which is changing. I mean, as long as that is not there, probably. So one has to spend a lot of time to understand that, okay, some stock is down now, but then whether it's down because of cyclical reasons, or are there structural changes which are happening on the industry?
Now, there is a question which I don't know whether you should be answering or I should be answering. Mukund is asking that should a person nearing retirement invest in a value fund? How about setting up an SWP from a value fund in the absence of any other pension or regular income?
I think it's best suited for you to answer.
Yeah, I would say that yes, it's a good idea first to be investing in equity to set up a SWP. But you have to be careful about 2-3 things while setting up an SIP for a crucial money which is your retirement money. There are 2-3 advantages of this. One is that equity is the only asset which is linked to real economy. So, and your idea is that your substantial part of your investment should be beating inflation, should be beating fixed income, should generate more return than that, and only equity can do it. So that's one. The other is the caution that you have to exercise is that you have to, at any cost, eliminate the possibility of catching a market high with such a crucial money. And so never, even if you have to set up your SWP, never invest at one go, never invest a large sum of money one fine day. Spread it over the next 12 months, 18 months, 24 months, so that you, even if it amounts to missing an opportunity, it is worth it. It is worthwhile, because with this money, your attitude to any big decline will be devastating. Third is that, should you be investing in a value fund? Yes, absolutely. They turn out to be more conservative. They are less racy, and so in that sense, the fund manager is also going to take care of, with his cash allocation and other things, will take a conservative stance, and that is good for you. And if you do this, and the fourth most important, in fact, that will be the most important thing, which is, don't have a withdrawal plan of more than 7%, 6 to 7% of your capital. Because if you have a higher withdrawal rate, you run the risk of consuming your capital in a down market. And in 2-3 years time, enough buffer will be created that, because only by doing this 6 to 7% withdrawal rate, you run the possibility of reducing the chance of consuming your capital. That apart, this will provide you an opportunity that your capital will rise over time, and you will have an inflation adjusted pension provided for it, because in 2-3 years time, you are assuming that you are investing 20 lakh rupees and withdrawing 7% from that. Now that 20 lakh after the 7% withdrawal becomes 23 lakh rupees in 2-3 years time. So the 7% of that 23 lakh rupees, when you revise your pension or revise your withdrawal rate, it will be 7% of the higher capital. So you run the possibility of having a inflation adjusted capital and income, which can be had only from equity. It cannot be had from any fixed income avenue, because even if you do a senior citizen saving investment, invest in senior citizen saving scheme or post office MIP or a debt fund, and if you consume all the gains, all the returns, your capital remains constant. And 5 years down the line, when your need for higher income arises, you can't have it, because then you will have to consume your capital. So it's a good idea, but I have listed the 4-5 rules which has to be followed at all times. So sorry for the long answer, but it was an important thing to be explained. I'll skip the second question because it is asking the same, it'll amount to repeating it, but I'll read the question anyway, because it has been answered already. Ashfaq is asking that, being a beginner, should I invest in value fund? Same reason, conservative fund, you can well consider. Now, Darshan is asking, would it be right to say that value funds give better returns only during turbulent times and underperform other categories during normal times?
Yes, so the experience which we have seen is the value funds, they would underperform when the markets are becoming much more frothy. So in times where they are stable, or whether declining, or even when there is a up move kind of a thing, value funds tend to do well, because you are backing a good,
in a difficult market they do well, in a mad market they don't do well.
Yeah, exactly. In a mad market they would write yes by you.
This question comes from Amit. I'm investing in 3 value funds through SIP. Besides this, I also have some SIPs running in large, mid and multi-cap fund. Is it fine to have this many value fund? I think I'll have to intervene here once again. Amit, don't invest in too many funds. And having 2-3 funds is good enough. If you have 3 value funds, besides that you have the large cap fund, you have the multi-cap fund, you have the mid-cap fund. There is a possibility that if you look at the underlying portfolio, by virtue of having all these funds, that you have an index fund, and you are incurring the cost of actively managed fund, which is higher than an index fund, which can cost you only 10 basis points, and you will be guaranteed of matching the index, never beating it, never underperforming it. So I would say get selective. Try and choose the best of the lot. In fact, and for large cap, I would say that the large cap funds have lost the plot. So make your portfolio with a mid cap, multi cap, and a value fund, and 3 funds will get you distinct advantage. Focus. At the same time, you will be interested. Having fewer fund also makes ensures that you are not drifting with your portfolio. Many a times we become there's an inertia. We just think that something is doing well, something is doing poorly. It doesn't matter. Not much amount invested there. Once you have some meaningful amount, you are interested, you will act or you will worry, and 2-3 funds will do the job better for you. Sunil is asking another question, which is, in case of equity fund, we use standard deviation, Sharpe ratio, beta and alpha to measure the performance. What ratios shall we consider while looking at the value fund? I think those variables are just as relevant if at all you use it, but mutual fund investors should actually do without doing many of these things.
Yeah, I mean, from an institutional, people would probably look at even portfolio characteristics. Maybe how does the fund's P, is it lower than the overall markets? Whether the price to book value, is it lower than the markets? Is the dividend yield higher than it is? But then those would be the very, very sophisticated kind of institutional investors, pensions, etc., which they are considering. As you rightly say, for another person, I mean, probably these would be as good how it is doing.
Now, Jagdish has a question and he's actually asking a tip from you. With that, would it be right to invest only when the Nifty PE is less than 20? Do you do this?
The Nifty PE or the overall benchmark PEs, probably they hide more than they reveal. For example, if you are looking in the current context, there are maybe 1 or 2 sectors which are priced very, very richly.
And that will be taking up.
Yeah, that will be taking out. And on the other side, there will be many, many stocks in the benchmark which would be priced on the very, very low side, probably.
It could be
cheap. So I mean, it would not be a right benchmark.
So benchmark PE may not be useful. Puneet is asking that while investing in value-oriented fund, should I invest regularly or will it be wise to hold or stop fresh investment whenever the market goes up? So should he wait to time the market?
I think so. What we have realized is that timing the market for the retail investor
is difficult. But you can do it.
Difficult. In the sense that we
in a limited way,
in the sense that what we look at is that is the stock below the limit which I would like to buy. So there are some kind of a discipline which is inbuilt. But then the investors who are investing in us, probably they do not need to worry, because for them, even if the markets are high, we would be sitting at, let us say, low cash, and vice versa. So for the investor, we are already doing the job for holding cash on behalf of him or her.
Okay. Thank you, Atul, for being here and sharing your insights and how to invest in turbulent times and value investing in turbulent times. Thank you, viewers, for being with us with Value Investing webinar.